Welcome back. Today we're going to be discussing treasury stock. It is actually the only topic that will be discussed in this lecture. We will go through a rather detailed example um, that you will want to make sure that you understand how these entries are made and the information flows because you will see a similar type problem on your homework and on an exam. First, let's just discuss what treasury stock is. Treasury stock is a corporation's own stock that A was outstanding, B has been acquired by the corporation, and C is not retired. The key thing to make sure you understand what treasury stock is, it represents shares that the corporation originally issued to the shareholders, but has since reacquired from the shareholders but has not yet retired those shares because they would be considering that they could reissue those shares again in the future. That is the main thing to make sure you understand that it is reacquired shares by the corporation and they have not yet been retired. Regarding the impact to equity, treasury stock is not an asset and it is reported on the balance sheet as a reduction of stockholders' equity. That is a key thing that I want to make sure that you understand is that it does not increase equity. It's not an additional form of capital. It is a reduction in the existing capital. Therefore, in that earlier illustration that we showed, stockholders' equity from common stock, preferred stock, retained earnings makes up the stockholders' equity. You would reduce that balance by any treasury stock, and that's what gets you to your final stockholders' equity balance you would see in the financials. So that is key to note that it is not an asset like common stock and preferred stock, or excuse me, I guess common stock and preferred stock are treated as equity, but treasury stock does not represent an asset because you cannot own yourself. If you reacquire these shares, just because you have the shares doesn't mean you have an asset in a company because you cannot own yourself. Therefore, this is reported as a reduction in stockholders' equity. That is the main thing I would like to highlight, that this reduces stockholders' equity. Regarding outstanding shares of the company, outstanding shares of the company are represented of shares that have been issued minus any treasury stock shares acquired. Therefore, if the company has 5,000 shares issued, but they have purchased 1,000 shares that were acquired, therefore the outstanding shares of the company would be 4,000 because you would subtract the amount of treasury stock shares that the company has reacquired. The reasons why corporations would purchase their outstanding stock, there's a number of reasons, and this is just briefly covering a few of those items. One, there's a tax benefit for distributions of excess cash to shareholders. They could increase their earnings per share and return on equity. We will discuss retained earnings, or sorry, earnings per share in more detail in chapter 16. But essentially, what the company would do is they would be purchasing their shares back, which would decrease the denominator of the earnings per share calculation, therefore increasing their earnings per share because they have less shares outstanding. It would provide stock for an employee's stock compensation contracts or meet potential merger needs. It would address takeover attempts and potentially reduce the number of shareholders. And E, to make a market for the stock. If the company issued stock in 2005 at a very low rate, but their stock was worth a substantial more in 2015, they could purchase back these shares and then hope that they can resell them on the market at a higher rate, therefore generating more money and making more of a market for their stock and more wanting to get more stockholders involved with their company and try to generate additional stockholders. Regarding the accounting for treasury stock, The most commonly used method is the cost method. That is the only method that we will focus on in this for the purposes of this class. The key thing to make sure you understand with the cost method is that the balances flow in and out of treasury stock account at the cost to acquire. The price that you paid to reacquire the shares, not the price of the par value of those shares or the additional paid in capital of those shares, but the specific cost that you paid to acquire. Please do not write down this next little bit. You can if you would like. However, I would encourage you to wait until we look into the next section. You can write down this part at the bottom about key steps for accounting for treasury stock transactions, but all of this information is listed on the next page. So if you feel free to flip to that page and write down some of these notes alongside each of these items if you wish. But I just wanted to show you a few tips I have as you begin to work a problem such as this for your homework, quiz, or the exam. So, in this example, Jayhawks Inc. has reacquired its own common stock for $22 a share. The original common stock had a par value of $10 per share and was sold for $25 per share. And then there are 5 transactions listed here, and this will go in detail as we get into the example. But a few things to highlight for you as you're starting a transaction to make sure you understand what you need to do. One, you need to determine what the acquisition price is. And for this example, it is the $22 per share. And this is the dollar amount that the treasury stock account will flow in and out of. So all entries that hit the treasury stock GL account will be reflective of this $22 per share price. Second, determine what the par value of the shares was, $10. The fair market value of the common stock, $25. Next, you would identify the amount of treasury stock acquired. So using the $22 cost to acquire, you would times that by the number of shares you reacquired. So in this example, 1,000, and that would get you 22,000. This is what your treasury stock account will start at. I would also like to note that in all the examples that we do regarding treasury stock, I will assume that the company had no previous treasury stock transactions. Therefore, you do not have to account for balances already in the account. We'll assume that it was a zero balance at the time of our transaction in our examples. So after you've identified the specific amount of treasury stock you're acquiring, you need to identify the amount of treasury stock that is reduced when the company has reissued stock. That is the $22. So what you will do when we reduce the treasury stock account for when we resell these shares, as in examples 2, 3, 4, and 5, you will use that $22 to flow the balances in and out of the treasury stock account. Any differences between the cash you receive and the reduction in treasury stock will be recorded to additional paid in capital for treasury stock or retained earnings. I will explain retained earnings when we get into the example. But the main driver of this is the fact that in this example, $22 was what it cost to reacquire the treasury stock. If you were to sell the shares for more than $22, as they do in number 2 here, $30 per share, you are receiving more money than what you're reducing in your treasury stock account because you only paid $22 to reacquire those shares. So that additional $8 per share is recorded in the additional paid in capital for treasury stock. And then the last key step will be if there are retirement of any shares. And we will discuss that in the next page in the example that we're getting ready to work through. So hopefully these steps will help you. I think it's first thing I would do when I come across one of these problems on your homework, quiz, or the exam would be to highlight these few things to make sure you understand that one, the balances in the treasury stock account flow in and out at the cost you paid to acquire, and as right here, the cost method, highlighting the par amount, the fair market value amount, the amount that you're initially going to start with in treasury stock, and then how the treasury stock account is adjusted accordingly when you resell the shares, and then also through the retirement of shares. So now let's go ahead and dive into this example, and we will go through step by step each of these transactions. First, number 1 here. This is where we will reacquire the 1,000 shares on April 1st, but we need to make sure that we know all of those key facts that we previously just stated, specifically the $22 per share that it costs to reacquire. Okay, first up, entry number 1. So we reacquired 1,000 shares on April 1st. So when we sold these shares, they were sold for $25 per share at a $10 par value. However, we know from the previous page that the cost method for treasury stock, you reflect the balances in the treasury stock account at the cost paid to acquire the shares back, not the original price. Therefore, we are going to spend $22,000 to reacquire these shares, which is the 1,000 shares that we reacquired times the $22 per share that it cost us. And then we're going to book this into treasury stock. And as you can see, the treasury stock account increases opposite of how the common stock account is reflected, because the common stock is a increase to the equity of the company, whereas treasury stock is a decrease to the company's equity. And so this is the first entry for reacquiring the shares. Remember, you need to focus on the cost to acquire, the $22 per share. That is the key to starting this problem correctly, and the key to how you will handle steps 2, 3, 4, and 5 here of this problem. Next, of those 1,000 shares that we just reacquired, the company has sold 500 of those shares of treasury stock for $30 per share. Therefore, on June 1st, the company received $15,000, which represents the 500 shares times the $30 per share that they received in cash for those shares. However, we know for treasury stock, the balances move at $22 per share, and therefore the entry to treasury stock will not be match the entry we made to cash. Therefore, we record the 500 shares at the $22, which is $11,000. Therefore, due to the fact that there is a difference between the price we received and the price that we are moving the treasury stock, aka the price that it cost for us to acquire, we need to reflect a balance in additional paid in capital. Therefore, we have $4,000 to additional paid in capital for treasury stock. This is reflective of the difference between the cost per share we received minus the cost that it took us to acquire the shares times the 500 shares that we resold. Therefore, you can see in this example how the cost to acquire is the only thing that impacts the treasury stock account, whereas the cash you receive and the additional paid in capital are a function of the per share balance you received in cash when you sold those shares back to the market. Okay, so now we've gone through number 1 and number 2. Before we move on to the next ones, I just want to make sure that we're all following how these basic entries are being made to the treasury stock account. The first entry is to establish when you reacquire the shares, and you establish a treasury stock account under the cost method for the cost of the shares for you to acquire, which was $22. Therefore, afterwards, when you sell these shares, you would adjust the treasury stock account for the shares using the cost using the cost to acquire the $22, but the cash account is reflective of the amount per share you received upon reselling these shares. Therefore, since the amount you sold them for was greater than the amount you acquired them for, you had to reflect the additional paid-in capital of treasury stock account of $4,000. Now, let's go on to number 3. So 3, 4, and 5, the entries are made very similar to what we just did for number 2. However, there is a point in time where the treasury stock additional paid-in capital account here will run out, and we will then have to reflect balances in retained earnings. So for number 3, we sell an additional 300 shares of the 1,000 we just acquired. So after this transaction, we will only have 200 shares left. And now we sold them for $9 per share. So we sold them for less than $9 than what it cost us to acquire. So we sold them for $9 a share. So we need to reflect the cash that we received for the sell, which is the 300 shares times the $9 to get $2,700. We need to decrease the treasury stock account because we sold those shares, but we need to reflect it at the $22. And as we've discussed, you move the balances in the treasury stock account at cost, at the cost to acquire, the $22. Therefore, we have decreased the treasury stock account by a higher amount than the cash that we received. Therefore, to balance our entries, we are going to have to decrease the additional paid-in capital of this transaction. Therefore, because we paid more than what we received, we have to decrease the additional paid-in capital. And so as you can see the difference between entries number 2 and number 3. In entry number 2, we sold them for an amount greater than the treasury stock to acquire. Therefore, we got to increase our additional paid-in capital for treasury stock. However, in entry number 3, we sold the shares for an amount less than what it cost us to acquire the treasury stock. Therefore, we have to decrease the additional paid-in capital in treasury stock. And as you can see, the entries in number 3 balance. The debit side equals 6,600, as does the credit side equals 6,600. That is the main takeaway that I want you to know between when you resell the shares is what happens when you resell the shares at an amount greater than what it costs you to acquire. This is the $30 per share. Or what happens when you resell the shares for an amount less than what it cost you to acquire, and that would be number 3, where $9 per share. Now for number 4. We sold 50 more shares of treasury stock for $11 per share. So this transaction will follow very similar to number 3 because we are selling them for an amount less than what it cost us to acquire. So first, what do we know? We know the cash that we received. We received $550, which is the 50 shares at $11 per share. We know what the reduction in treasury stock is. It is going to be the 50 shares times $22, which is the cost to acquire, and that gives us $1,100. Therefore, to balance these entries, we know that we need a $550 entry to the debit. Consistent with entry number 3, because we paid more to acquire than what we are receiving upon reselling these shares, we have to decrease the additional paid in capital of treasury stock. However, there is only $100 left in the additional paid in capital for treasury stock. Therefore, the account is closed. We cannot put the full $550 we need because there is only $100 left in this account. Therefore, this closes out, zeroes out, and the remaining difference we need to reflect in retained earnings. And we will get to entry number 5 in a minute. But that's one thing to make sure you understand is that you keep decreasing the additional paid in capital treasury stock account as long as there is a balance to decrease. Once you close that account, or if there is nothing in that account, then you will always enter the offsetting entry to retained earnings, which is a decrease to equity. Now, number 5, we sell similar to what we just did for number 4. We sold 50 shares for $11 per share. So we were first do the entry we know for cash of $550. We know what we need to do for treasury stock. We need to remove it at the cost acquired of $1,100, which is the 50 times the $22. That was the cost to acquire. Then, since there is no additional paid in capital of treasury stock left, because that count is now closed out to zero, we have to book the remaining entry, the 550, to retained earnings, which also again reduces our equity. On the next page, we're going to discuss one more entry, and that relates to the retirement of the remaining shares. But before we move on, I just want to make sure we understand the key things of highlighting your focus on the cost method so that you move the balances in and out of treasury stock at the cost to acquire, the $22 per share. Next, I would like to make note that if the cost to acquire is less than the cost you receive to resell the balance, then you're going to have an entry that increases additional paid in capital for treasury stock. And this represents the fact that you're receiving more for the reselling of those shares than what you paid to acquire. Next, I'd like to make note that the opposite of that, if the cost to acquire is greater than the price you received for reselling those shares, then you are going to be decreasing the additional paid in capital treasury stock account. However, if you only can do it up to the amount in the additional paid in capital treasury stock account. Once it is closed, zeroed out, the remaining balances will be reflected in retained earnings. Therefore, if we never had established this $4,000 entry here to additional paid in capital for treasury stock, we would have reduced all of these balances would have been within retained earnings. So now let's move on to the retirement of treasury stock shares. And as we discussed at the beginning of this lecture, treasury stock represents shares that are A, outstanding, B, have been reacquired by the firm, and C, have not been retired. So once these shares are retired, as we will go through in this example, you will remove the entire treasury stock balance associated with those shares, as well as remove the common stock, because once you retire the shares, you are no longer allowed to reissue those shares back to the public as common stock. And there is a note that basically says just that right there. You remove the original common stock as retirement because you're no longer eligible to reissue those shares once they are retired. From our example on the previous page, if you do these and take the $22,000 minus all of those entries, it gives you $2,200 as the balance at the date of retirement. In this example, we are retiring all of the remaining treasury stock shares. I will make note that you do not have to retire the entire treasury stock share amount. So you could have an example where I would say that the company elected to retire 50 of the remaining 100 shares. And then in this if that example were to occur, you would just have to remove only the part of the treasury stock and the common stock related to those 50 shares, not the entire amount remaining in treasury stock. However, for this example, we are retiring 100% of the treasury stock shares outstanding. Therefore, your first step is you want to close the treasury stock account. We know that we have $2,200 and we are retiring the remaining 100 shares. So we are removing 100 shares at the $22 that it cost us to acquire, therefore zeroing out our treasury stock account. Since we are retiring these shares, we can no longer reissue them. Therefore, the common stock associated with these shares has to be removed. As we discussed on the previous page, the par value for these shares is $10 per share, and the fair market value of these shares was 25. Therefore, the difference between par and fair market value is 15. Therefore, you will record this entry as a removal of common stock at its par value, similar to how we have accounted for all common stock transactions thus far. The balances in those accounts, the capital stock accounts, common stock and preferred stock, are always increased and decreased by the par value of the shares. We also know that we had an additional paid-in capital when we sold these shares because we sold them for $25 when the par was only 10. Therefore, we need to remove the additional paid-in capital associated with those 100 shares we are retiring. Therefore, decreasing additional paid-in capital by $1,500. As you can see, our entries do not balance at the moment. Therefore, we have an additional entry that needs to be made, and this goes to the additional paid-in capital of treasury stock retirement. And what this difference represents is the fact that you originally sold the shares for $25. However, it only cost you $22 to reacquire them. Therefore, you are recognizing a $300 benefit because you sold them at a higher amount than what it cost you to acquire them and thus retire them. Therefore, you're benefiting by $300. If this was the opposite case, where you sold them for less than what it cost you to acquire them, you would have an entry here that would decrease the additional paid-in capital of treasury stock account, or it would impact retained earnings, and we will go through an example of that just shortly. But this is the basic entry you'll be required to know for purposes of retirement of the treasury stock shares. Again, I just want to make sure you understand that you do not have to retire all of the treasury stock at one time. If, for example, I were said you would had to retire half of the remaining shares, so 50 shares, instead of the 100 that was remaining, each of these balances would be reduced by half because you would only need to record the amount of shares retired times their appropriate balances. Now, let's go through an example of retiring treasury stock when the cost per share to acquire is greater than the cost of the original issuance fair market value. Therefore, this is an instance where the cost I paid to acquire the share was greater than what I originally sold the share at. So in our previous example, we sold the shares for $25 and reacquired them for $22. In this example, we reacquired the shares for $20, but we originally only sold them for $16. Therefore, we are paying more now to reacquire the share than what we received initially. So at the cost to acquire, we need to make an entry. And then first we need to record what we know at treasury stock, which is 20,000. We know that we need to reflect the 1,000 shares times the cost that we paid to acquire them, because that is how you do the cost method under treasury stock. And we paid the cash as well to reflect that balance. 1 week later, this company, ABC Inc., decided they wanted to retire all the remaining shares that they had just acquired, the 1,000 shares. Therefore, consistent with what we did previously, we need to remove our treasury stock, the 20,000, which we calculated here, and this would be the same. We're retiring 1,000 shares at the $20 per share we paid to acquire them. We need to remove the common stock from their books using the par amount, and then the additional paid in capital using the difference between fair market value and par. So we know that the par value on these shares was $5. Therefore, we were reducing common stock by $5,000, which is the 1,000 shares times the $5. We also need to reduce the additional paid in capital associated with those shares. And the reason that there was an additional paid in capital when we originally sold them was because we sold them for 16 and the par was only 5. Therefore, consistent with the previous times that we have covered common stock entries in this lecture, you have to establish an additional paid in capital when the cost you received when you sold them is greater than its par value. And you would use $11 here, which is 16 times minus 5, which is the cost per share from fair market value minus the $5 par. As you can see, these entries do not offset. We are still $4,000 short. And as I mentioned previously, when you have a circumstance where the cost you paid to reacquire the shares is greater than the cost that you originally sold them for, you are going to reflect a difference in this additional paid in capital of treasury stock retirement or retained earnings. The only time in which this would hit treasury stock retirement is if there was an existing balance here. Otherwise, they would hit retain earnings, and that is what you need to make sure you are aware of. This represents a loss because you paid more than what you originally sold them at, whereas in this example, this is recognized as a gain or a benefit because you sold them at a greater amount than what it cost you to reacquire them. So they're the opposite for this entry. Make sure that you are aware of both of these transactions when it comes to retirement, on the difference between what happens when you pay more or less than what you originally sold them for. Also to note, you may have questions on your homework, quiz, or exam where I just give you this part of the problem, just the retirement aspect, similar to what we did down here in this example. Make sure that you can calculate and do this type of problem given the information is shown. I will give you the same information that is present with regards to the cost to acquire, the par value, and the price that you originally sold the shares for. So you'll have all the information you need to record these entries. Also, make sure that you are prepared to complete a problem where you go through this entire example that we just did, from the reacquiring of the shares to selling of some of the shares, all the way through the retirement of the shares. I can guarantee you on your exam you will have a problem very similar to this. In addition, on your homework, I have included a problem like this, but it also incorporates a few additional items with regards to establishing common stock and preferred stock. So all you will do in that example is you will book the entries for common stock and preferred stock, similar to how we have previously discussed for common stock and how the next lecture discussed on preferred stock, and then you just go through the problem of doing the treasury stock accounting. It's not trying to confuse you in any way, it's just trying to incorporate multiple concepts that we have covered thus far in this lecture and in the third lecture that you will listen to after this one. That is all for today's lecture. We were just covering treasury stock in this example. I kind of wanted to segregate it from common stock and preferred stock to make sure everything makes sense. But before we end for today, I want to go through really quickly to make sure you understand the key items from treasury stock. Make sure that you understand that it is the reacquired shares by the corporation and they have not been retired. Once they are retired, they are no longer reflected as treasury stock or common stock. Make sure you are aware of that. Make sure you understand that treasury stock is a reduction of stockholders' equity. As you can see in that example that we just went through, when we increased the treasury stock account, we were putting it as a debit entry, which is the opposite of what we would do for common stock and preferred stock, therefore reducing equity. Make sure you understand the method most commonly used for treasury stock of the cost method. Make sure you always remember that the balances in the treasury stock account flow in and out at the cost that you paid to acquire those shares back. Make sure you understand the difference in the entries for when you paid more than what you received. So when you paid more to acquire than what you received when you resold it. And then also the entries that are required when you paid less than what you received when you resold the shares, as they are differencing in the transaction of how they work. Make sure you remember that you only make the entries to this account, specifically these debit entries, when there is a balance to remove. Therefore, if there was no balance in this account, these entries would be reflected in retained earnings directly. And then lastly, make sure you understand the difference when retiring the shares. What happens in this entry when you retired the shares in which you paid less than what you originally sold them for? So we, in this example, we sold them for 25, but we reacquired at 22. And then also what happens when you retire them at a price higher than what you originally sold them at. So the $20 to acquire versus the 16 that you sold them for initially upon issuance. That will wrap it up for today's lecture on treasury stock. Hopefully this walking through this example will be extremely helpful. I will work to have an additional problem for you to work one or two treasury stock examples like this so you're well prepared for the exam. You also have a question like this on your homework. And this example is probably as complicated as what you will see on an exam. So if you make sure you can understand the things that we just covered, specifically those areas I just highlighted and the differences, you should be able to do these entries relatively easy, and you should be able to knock it out of the park when it comes to the exam. After this lecture, you will have the opportunity to listen to the third lecture in Chapter 15, which covers preferred stock and dividends. After that, I encourage you to begin work on your homework and then taking your quiz and then preparing for the first exam. Please note that you do have a deadline for the homework and the quiz associated with this chapter, and that the first exam is scheduled for February 29th, which is a Monday. The test will be held in the evening, and I will provide the times and location on campus for that exam at a later date. Have a good day.